Hi, everyone. Welcome back for the HFRI February 2025 Performance Snapshot. Joining me today is Ken Hines, President of HFR Index. Welcome back, Ken.
Thanks for having me on, Anika.
Ken, could you please talk us through the month of February for the HFRI?
Yeah, volatility that really started to pick up in the latter part of February really defined the month from a market cycle standpoint. And that volatility has absolutely accelerated into March, with really the leading area of that volatility being technology stocks and crypto, both sharply off of all-time highs from just a few weeks ago. And the good news is that hedge funds have really navigated this uptick in volatility extremely well. We have two of the four strategy areas actually are positive for the month of February. And obviously, we're continuing to see how they position. But really, the risk-off sentiment has been very strong as a market cycle in the latter part of February and the first part of March. And we're seeing some very exciting performance of hedge funds effectively navigating this very volatile environment.
Okay, so how do things look at the composite level?
So you have here February, which obviously was the beginning of this uptick in volatility. And with that, even though it was, like I said, very concentrated in technology stocks, you saw a decline for the month of 4%, which obviously that has accelerated here in the first week and a day of March. And so considering hedge fund performance in February relative to that decline, you saw a gain in fixed income based relative value arbitrage, which, as you know, primarily long a bond and short a bond or short a stock against it in relative value arbitrage. This includes credit multi-strategy, some of the larger funds in the industry, a gain of 0.75% there, which again, not a huge gain, but a great gain in a declining equity market, and also positive performance from the HFRI event driven, which is interesting because this is generally thought of as more of a directional strategy. Again, not a huge gain, a little more than 30 basis points for the month, but a gain when obviously equity markets were posting sharp declines and risk off sentiment was very strong. And so it's impressive that those two were positive for the month. Then we have the composites really all just about in the same place, a little less than 50 basis point decline for the overall HFRI. And then you see the 500 and the 400 in a very close place to those, as we would expect. And then the latter two performers, equity hedge and macro, declined by 0.2% and 1.2%.
And how about at the sub-strategy level?
Yeah, here the story is, I think, probably a little bit more positive, really, because you see even stronger performance at the sub-strategy level. Obviously, these are smaller areas in the strategies and a little more specific, but you did see a very strong month in convertible arbitrage, which, as you know, is a long volatility position, long a bond and short a stock. And we saw a gain of about 3.4% in that very traditional hedge fund strategy. Staying with the multi-strategy concept, we saw equity hedge multi-strategy gain about 3.2%, 3.1% for equity hedge quantitative directional, which you know is funds that are very much like CTAs, but just only in the equity space and not across all asset classes. Equity hedge quantitative directional, 3.1% there, and a 2% gain in macro active trading, which I think it's pretty intuitive that these strategies have done well in this uptick in volatility that we've seen. A lot of those are very fast tactical adjustment strategies that include both fundamental and quantitative strategies, again at 2% there, and then about 1.6% in the macro multi-strategy, which includes quantitative and fundamental strategies.
So given a difficult February for a lot of the composites, how do things look compared to the start of the year?
We see really leadership in February the same as what we're seeing year to date. Obviously, it's only a couple of months. But one thing that I think is very exciting to point out, relative value arbitrage has had 16 consecutive positive months of performance. And obviously that includes not just environments like February where you have volatility increasing and yields falling. It includes a lot of time when you saw yields rising as well. So 1.9% gain thus far for the year in what's, I guess, categorically kind of lowest volatility strategy. And then 1.1% in equity hedge. Again, even with the shifting and the risk aversion coming on very strong in the end of February, you still see a good gain for the event-driven strategies. And then macro really just flat for the year. Here we have it down 2 basis points, but essentially navigating all strategies, 2 months into the year, seeing a big uptick in volatility, and these strategies are doing a good job of navigating it.
And what about at the sub-strategy level so far in the year?
Yeah, again, the multi-strategies are still strong. You can see equity hedge multi, a very strong gain there, about 8%. And again, when you look at the equity hedge multi-strategies, and it's funds that are primarily equity in nature, but don't fit into any one of the sub-strategies they have, but they have multiple parts of the fund and different sub-strategies that we have. So a gain of nearly 8% in the first 2 months of the year, 4.6% in convertible arbitrage. So not just a good February, but a good couple of months. And that was also a strong area of performance, as you recall, in 2024. Staying with the multi-strategy, you can see 4.1% in the macro multi-strategy. That's going to include funds across all of these areas: CTA, fundamental, currency, commodity, active trading. All of those types of strategies come into the macro multi-strategy. And then quantitative directional, we talked about that earlier, 3.9% gain there. And then 3.1 in the macro commodity index, which is interesting because that was actually an area of decline in the month of February. So strong performance year to date, 3.1%. Again, you look overall with the gain in January, decline in February, you're looking at a 2.5% decline for equities thus far for the year.
Excellent. Thank you. And we invite all our viewers to visit our website at hfr.com, register so that you can stay up to date for everything new from HFR. Also download the Investor Guidebook for important use cases of the indices and our data. There's more on HFR's media platform. And for further inquiries, please reach out to Ken Hines or to indexdata@hfr.com. Thank you, Ken.
Great. Thanks for having me on.